Yeah, so in general, we see global manufacturing healing. So we're all focused on the coronavirus and Boeing, but what hasn't gotten a lot of news today is that European manufacturing PMI really strengthened significantly, good bounce, Japan as well. And so the underlying story is that, all of the effects of the trade tensions are kind of getting out. There's kind of the trade de-escalation is helping. And now we're inflecting higher in the global economy, which should be good for industrials.
But doesn't it take time for the pickup in economic growth to actually feed into corporate profits?
It does, but the market won't wait. So I think the multiples you'll see rise, and I think that's why we've seen industrials perform better and better, even as some of the earnings haven't really come through just yet, is because the market sees that this improvement is coming.
But in the meantime, Bank of America says this market's getting a little ahead of itself. It's getting frothy. Paul Tudor Jones just the other day said that this market reminds him of 1999.
In some ways, yeah. I mean, you've got 18% of the S&P's market cap concentrated in 5 stocks. The last time we saw that was, in fact, 1999. And, we talked last week about the market getting ahead of itself. You saw some technical signs that were overbought. We've seen some indications that maybe valuations are a little on the high side. So it's not surprising that the market would correct based on these 2 items. You don't want to underestimate the potential impact of the coronavirus if it becomes very serious. But we've gone through this before. The market sold off on SARS. It sold off on other viruses that have spread around the world. You don't want to be too cavalier about it, but certainly the market's been looking for an excuse to sell off. Seems what we're getting today.
Are we getting ahead of ourselves? I mean, you're pointing to yet another part of the business cycle starting to rear itself up. If in fact industrials are starting to re-heal themselves right now, but you already have a market that's been anticipating this for a long time, I guess.
Yeah, I think so. What I would just say is that turning points in the economy can be the most powerful for price action. It's when people underestimate first things getting less bad, then them getting good, and then them getting more powerful in the economy. And we're still trading that. There's still a lot of skepticism about the strength of this economic rebound. We actually think it's going to be a lot more powerful than people think. We can't forget just how many central banks around the world eased, and that's just hitting the economy now with a lag.
And they have the hold button on right now.
Speaking of central banks, Fed meeting next week. How much do you think the dialogue will be centered around these larger events, whether it be coronavirus or the drag of Boeing's troubles on economic growth?
So they'll certainly be part of the discussion. I think the Fed has expanded its mandate away from just data dependent from the U.S. economy, but globally data dependent, focused on geopolitical issues. And so certainly expect these topics to come up in Governor Powell's press conference. I think in general, he will present them as risks, but not something that the Fed is overly concerned about.
I mean, no disrespect, Matt, but I mean, I think the Fed has always looked at global data. I mean, as long as our career goes on, they've looked at things outside the United States. People argue about whether or not.
Why wouldn't they?
Yeah, well, yeah. I mean, if it's a factor that could affect domestic growth, they'll consider it. I think the other thing too, and where I might differ a little bit is look, we started to see a rebound in global interest rates late last year. So all those negative, $17 trillion worth of negative interest rates has begun to fade, and we're seeing rates move back up towards zero around the world, which was an early indicator that the worst might be behind us. I would be a little less optimistic about the strength of growth and say that maybe the Fed did achieve a soft landing, and that might be the operating principle going forward. It's interesting to note that the Fed fund futures market is now beginning to price in a rate cut in June for the first time this year. Now, I don't know why. The economy looks just fine. It's almost Goldilocks-ish, but some of the futures traders might be getting ahead of themselves with the notion of a cut this year.
Especially in an election year.